In this video, we are going to do a recap on financial statements of a firm. We will start with the balance sheet, which is an accountant's snapshot of the firm's accounting value at a specific point in time. The balance sheet identity is assets equals liabilities plus stockholders' equity. The same balance sheet you went over in your accounting classes. As always, assets is what you own or the company owns. Liabilities are what the company owes. There's a lot of debt in there, but there's also other things like wages payable, etc. So things the company has obligations to. And then whatever's left over is the stockholders' equity. That's the owner's piece of the assets. When using the balance sheet for analysis purposes, the typical key items are we like to measure the liquidity of the firm, the debt versus the equity, and the value versus cost. We'll address more details on these later. Now, are there more things that can be looked at in the balance sheet? Yes, but these are the three key ones that we're going to be focusing in this course. So liquidity refers to the ease and quickness with which assets can be converted to cash without a significant loss in value. Now, it's not just the fact that you convert something to cash, it's how fast you can convert it without having to give up value. For example, I can sell a house within a day if I sell it for $3. So it's fast, but a lot of that value would have been lost in order to get it there. So that would not be considered liquid. So something that you can sell it very close to the value. It doesn't have to be perfect, but you don't have a significant loss of value and you convert it to cash quickly in very little time, then the more liquidity. Now, it's not an on and off switch. There's degrees to this: very liquid, somewhat liquid, moderately liquid, illiquid, as in hard to convert to cash. And so there's degrees to this. When you look at a balance sheet, the asset side is typically split into current assets and fixed assets, also known as long-term assets. These are placed in the order of liquidity. That's why when you look at the assets in a balance sheet, current assets are on top, but even in there, they're in order of liquidity. The very top one is going to be the cash in the company. It does not get any more liquid than actual cash. Then typically you see accounts receivable. Well, you may see marketable securities because those are very highly liquid, or money market tools, money market securities. Those are very highly liquid as well, but they don't necessarily have to be there. Then the next one will be something like accounts receivable. That's next in the pecking order when it comes to liquidity. Then you may have inventory. Those are the typical ones in that order of liquidity. The more liquid a firm's asset, the less likely the firm is to experience problems meeting short-term obligations. When you look at the liability side of the balance sheet, you also see short-term liabilities and long-term liabilities. Typically, it's long-term debt in that block. But the point is that these short-term liabilities are things you have to pay in the very near future, those obligations. So if you have a good amount of cash or accounts receivable or marketable securities, you should always be able to get some cash on hand to take care of those liabilities and not run into liquidity problems. Liquid assets frequently have lower rates of return than fixed assets. So what happens is that the more liquid it is, the less gains you can get from it. So cash itself just sitting there is not doing anything. So you're not getting anything. If anything, you might be losing money because of inflation. And marketable securities, on the other hand, May be earning a couple percentage points here and there, not a lot, but the benefit you have it there because of the high liquidity, not because of those things are very low volatility. So it's very low risk, which comes with very low return. Now, when it comes uh comparing debt versus equity, so you may own bonds on a company. That means you are the lender of money to that company when you buy a bond, or you may own shares, equity. You could own both, but let's just separate it for now. So when it's time to pay money to the investors in the firm, whether it's debt like bonds or stocks in the equity side, the debt holders are the ones that have first claim. So cash has to be paid to debt holders first. And then if there's cash left, it can go to the stockholders. When it comes to value versus cost, under GAAP, the generally accepted accounting principles, the assets should be carried at the cost, at the amount of what you paid for them, not the market value. So if something goes up in value, let's say your inventory or your real estate, then you do not get to increase those numbers in the balance sheet. It goes on cost, and especially the depreciate things that depreciate, if anything, it'll be declining. It is true that the market value would be higher. It is true that if you were to sell it, you'll get more money. That was the balance sheet. But unless you are doing a different type of analysis, which is fair when you do a market value analysis, when you record or fill in your balance sheet, it has to be at cost. In some cases, you're allowed to make adjustments for changes in market value, but there's a process for that. You just don't get to change it because you want to. Now let's move on to the income statement. Now, when you were in your accounting classes, you remember the income statement being a long bunch of entries and a lot of calculations. Well, that still applies, but right now we're just talking about the fundamental of the income statement, the fundamentals. So it measures the financial performance over a specific period of time, typically a year. Now, you do have quarterly reports, but typically we like to look at the year one because it covers all the things that could have happened, if there's any seasonal issues, etc. But then the most basic form is revenue, all the money that came in the company through sales, etc. Then all the expenses, all the costs, all the expenses, everything that went out in order to run the company. And then whatever's left over, include and expenses here also includes taxes that you paid. Once you pay taxes, you paid employees, paid for all your operation cost, et cetera, and your variable cost of your product or your gross up to get your gross profit, all those things. Once you get all those out, cost of goods sold, et cetera, whatever is left, that's your income. You typically know it as net income. When analyzing the income statement or using the income statement to analyze a company, the three things to keep in mind. Now, there's a lot more to it, but these are the three ones that always have to be there. You need to keep in mind the generally accepted accounting principles in order to stay in compliance. Always keep in mind the non-cash items. Depreciation is always the biggest non-cash item. Companies sometimes can show a negative net income, in other words, a net loss, but they have positive cash flow. And it's because depreciation, the way it works, may eat away at the revenues of the company. And if anything, it lowers your tax liability. And even if it looks like you lost money, you may have a lot of positive cash flow. It just really depends the type of company you are, and you have high depreciating assets. Time and costs. Time and costs. That's always how long you are looking at it. Is it a year? Is it a quarter? Is it a over several years period? Some industries, the cycle is more than a year. So when you analyze it, you want to be conscious about that. Now, just to give some gap knowledge in this lecture, we're going to talk about the matching principle. It dictates that revenues be matched with expenses. So what they're saying is income is reported when it's earned, even though no cash flow may have occurred. To review some of this gap stuff, there is the cash method and the accrual method. What they're talking about on this slide is the accrual method, not the cash method. Small businesses, medium businesses can get away with doing a cash method accounting, but once you are in the big leagues, to say that way, you should follow the accrual method. So once you earned, they may not pay you now. Your client might pay you later. So it's going to go in accounts receivable. However, you still count it as revenue, even though you have not received the cash. If for some reason they don't pay you later, then you write the loss or the unrealized revenue, and then you can make tax adjustments and all that. But it's always assumed that you will be able to collect. Non-cash items, depreciation, as I mentioned, is always the big one. No firm ever writes a check for depreciation, meaning that in your income statement, you're going to see a depreciation expense, but it's not something you paid. To give a quick explanation, let's say you buy a building, and so all that money was paid up front. You purchased the building. That's when the cash moved, but you're not going to put that in the income statement as in all these millions of dollars went out immediately. No, you're going to depreciate the building, let's say 20 years, for example. So you're going to divide that money you put out front and depreciate it every year. But remember, the cash already left at the beginning. So if that depreciation is no cash moving, it's just reflecting, you're recovering pretty much that money that went out. But it's a non-cash transaction. That cash went out in the investment at the beginning. Time and cost. In the short run, certain equipment, resources, and commitments of the firm are fixed, but the firm can vary such inputs as labor and raw materials. Let's explain that for a moment before going to the next line. You may recall seeing things or hearing things or working with variable cost and fixed cost that could have been in your economics class and or your accounting class or some other class as well, but typically that's where you see it. What they're saying here is that in the short run, yes, there is items that are variable cost, things you can change immediately. Then there's the fixed cost, things you cannot change that fast. Machinery and a building or things like that. They might be difficult to go ahead and have to adjust those. So in the short run, the short term, we do differentiate between variable costs, things you can change immediately or very fast, and things that are not cannot be changed that fast. So those are more fixed costs. However, when you look at it over a several year period, then you have time. So everything is variable. It's just that some take more time to change and some take less time. But because you're looking at a long period of time already, several years at a time, then yeah, everything is changeable once you have the time available to you. Speaking of taxes, now you should have reviewed in your accounting class what the marginal tax rates. So that means that as you make more money, you start going up in percentage that you pay in taxes for the next dollar. And then you use that to calculate the taxes you actually own. However, the tax you actually owe to your tax liability. to the IRS. However, for other calculations, we're interested in what we call the effective tax rate. So your top tax rate that you pay on the marginal tax rates, that is not your effective tax rate. So what we do is we take, once you calculate with the marginal tax rate, you take that number and you divide it by the taxable income. It's going to give you some percentage. We call that the average tax rate or the effective tax rate. And it's always going to be lower than your top marginal tax rate. Net working capital. You may have seen this before. We're going to review it because we're going to be using this later on. Net working capital is as simple as you take your current assets minus your current liabilities. You want this number to be positive. Now, what number is a good one or a bad one? There is no straight answer because it really depends on your industry. A number that is too high might be a bad thing because then your company's not investing and growing that much. A number too low can put you in liquidity risks. So that's something to think about. Cash flows. We spoke about the income statement and net income, and because of depreciation and non-cash items, net income is not actual cash. So then we have to have a separate statement where we actually measure the cash in and the cash out. And it's as simple as all the actual cash that came in during a period and all the actual cash that went out during a period. So depending on how much the company has an account receivables and depreciation, those will be the two big ones that influence the difference between net income and cash flows. At the end of the day, the cash flow from assets should always equals the cash flow dedicated to bondholders and to stockholders. So just like the balance sheet, assets equals liabilities plus stockholders' equity, the cash flow will have the same identity. The accounting statement of cash flows is typically reported in three parts. Cash flow from operating activities. That is, most of that will show in the income statement. This is your actual operations. Money that came in, the money that went out in order to get that money to come in, and what you got left over. Cash flow from investing activities. Any money that was used for investment. Now, investment here could be marketable securities or any kind of other typical investing in that sense of some kind of security, or investing in another company and you have a minority ownership or something like that. But it also means if you buy a building or new machinery, new equipment, or expand, that's also an investment in the company. You're investing in assets to grow the company. So that will be a cash flow for investing activities. Cash flow from financing activities would be, for example, if you sell bonds and sell shares in order to raise capital for the firm, those are financing activities. So when you sell those bonds or you issue more shares, you have a cash flow goes up because you're receiving cash. Now, let's say some bonds mature, so that cash flow stops going out, those payments. Or let's say that you do a stock buyback. Companies do that all the time. At that point, you're buying stocks back to the company, so cash is going out. Those are examples. There's a lot more to it. Dividends are in there too. Cash flow management. Just what it sounds like. How do you manage your cash flow? Now, this is a very important part of finance and accounting. Companies, when they go bankrupt, It's not because they had a net loss or negative net income. They go bankrupt when they run out of cash. That's when the bankruptcy happens. Not necessarily. You can go years with net losses, but as long as the cash flow is positive, you can continue operating as long as you have cash on hand. So total cash flow is more objective, but the underlying components may also be managed. Moving cash flow from the investing section to the operating section may make the firm business appear more stable. Okay, so that what they're saying is that would be like a trick that that a company will use to try to make themselves look better. But not recommended. Cash flows will always catch up with you. Every time somebody has tried this, uh, they eventually end up in a bad place. These are the stories of Enron and all these other big companies, WorldCom, et cetera, when they try to move these numbers around and eventually catches up with them because you can write it however you want on paper, but the actual cash on hand will dictate what happens. Now, so the importance of managing your cash flow is because two main things. First, I already mentioned, that's how you end up in bankruptcy. If you run out of cash, if you don't manage properly, you don't do proper short-term cash management, you can end up in bankruptcy. Also, in finance, when we are evaluating the value of a firm, we are more interested on their cash flows than we are on their net income. Now, we're not saying that net income and balance sheet are meaningless. No, those are very important things for efficiency measures, liquidity, et cetera. But at the end of the day, cash is what matters. Are we getting cash, and is the cash we're getting growing? And that's going to dictate the value, the ultimate value of the firm. More on that later on this course. That will be it for this video. See you on the next one.